Imagine waking up one morning, checking your bank balance, and realizing that your money is not really just your money anymore. It is also someone else's. That can feel both comforting and terrifying at the same time. And that is exactly the feeling people get when they open a joint bank account. But should you actually get one? Or is it a financial trap waiting to happen? Stay with me, because by the end of this video, you will know the answer, and I will also reveal one thing about joint accounts that most people never think about until it is too late. Number 1. What is a joint bank account? A joint bank account works just like a regular checking or savings account, except more than one person is listed as the account holder. Both people have equal access to the money inside. That means you can deposit, withdraw, and spend money without needing the other person's permission. Think of it like a shared wallet sitting on the kitchen counter. You both can put cash in, and you both can grab cash out. Example, let's say Alex and Jordan are married. They both get their paychecks direct deposited into one joint account. They use that account to pay rent, utilities, and groceries. It simplifies things because everything comes from the same pot. Number 2. Why do people open joint bank accounts? The biggest reason is convenience. It is easier to track bills when everything comes from one place. Couples often feel it builds trust, too, because it shows they are open about money. Parents sometimes open joint accounts with teenagers heading to college. This way, the teen can access money for books or emergencies, while the parent can monitor spending. Roommates rarely open joint accounts, but married couples or long-term partners often do. In fact, surveys show that over 70% of married couples in the USA combine at least some of their money in a joint account. Number 3. The benefits of a joint account. Benefit 1 is simplicity. Instead of transferring money back and forth, everything is already in one place. Bills get paid faster and budgeting feels easier. Benefit 2 is transparency. Since both names are on the account, both partners can see exactly what is happening with the money. There is no mystery spending. Benefit 3 is teamwork. A joint account encourages couples to plan together. Imagine saving for a vacation. If both of you see the balance growing in one account, it creates excitement and motivation. Example, Emily and Chris want to buy a car. By saving together in their joint account, they both feel equally invested in reaching that goal. Number 4. The risks you cannot ignore. Here is the scary part. Joint accounts are based on full trust. That means either person can drain the account at any time. There are no legal protections that stop them. If one person has bad spending habits, the other suffers. If one racks up overdraft fees, both are responsible. And if things go sour in the relationship, things get messy. A breakup or divorce can turn a joint account into a battlefield. Example, imagine you and your partner each contribute $500 a month. But suddenly, your partner decides to take out $2,000 without telling you. The bank will not stop them because their name is on the account too. Number 5. Joint account and debt. Here is something most beginners miss. Even if you are careful, your partner's financial habits can drag you down. If the account goes into the negative, both of you are equally responsible for paying it back. If debt collectors come knocking, they can legally go after both names on the account. Example, if Sam uses the joint account to pay for expensive electronics and overdrafts the account, Taylor is equally on the hook to cover the fees, even if Taylor never approved the purchase. Number 6. Privacy trade-offs. When you have a joint account, you lose a bit of financial privacy. Every transaction is visible. That means surprise gifts or secret coffee splurges are not so secret anymore. For some couples, this can create unnecessary tension. It is one thing to share bills. It is another thing to explain why you bought fast food 3 times this week. Example, imagine trying to surprise your spouse with an anniversary trip. If you book the flight using the joint account, the surprise is gone the second they log in and see airline purchase. Number 7. Alternatives to joint accounts. Here is where it gets interesting. You do not have to choose between all joint and all separate. Many couples use a hybrid system. They keep individual accounts for personal spending and a joint account for shared expenses like rent and groceries. This way, there is both teamwork and independence. Example, Alex and Jamie each keep their own checking accounts, but they also deposit $800 each month into one joint account. That account only covers rent, utilities, and groceries. Everything else stays separate. This system prevents fights over personal spending while still making bills easy to manage. Number 8. When a joint account makes sense. A joint account works best when there is high trust and good communication. Married couples who openly discuss money tend to benefit the most. It also makes sense if you are managing shared goals like buying a house, raising kids, or saving for retirement. It can also be helpful when caring for elderly parents. If you are the adult child responsible for paying bills on their behalf, a joint account makes that process easier. Number 9. When you should think twice. If one person has a history of overspending, gambling, or hiding debt, a joint account is dangerous. It is also risky in brand new relationships. If you have only been dating a few months, putting your money together is like handing over your car keys to a stranger. Even in marriage, if money arguments are frequent, it may be smarter to keep things separate until trust is rebuilt. Number 10. Joint accounts and legal issues. Here is the part most people never think about. Legally, joint accounts usually come with right of survivorship. That means if one account holder passes away, the money automatically belongs to the other. This can be good, but it can also cause problems with inheritance. Imagine a parent adds one adult child to a joint account for convenience. If that parent passes away, the money may skip the other siblings entirely, no matter what the will says. This is one of the hidden surprises about joint accounts that catches families off guard. Number 11. Tips to make it work. If you do decide to open a joint account, set clear rules. Agree on what expenses come from that account. Decide how much each person contributes every month. Consider setting a spending limit where anything above a certain amount needs discussion first. For example, anything over $200, let's talk before spending. And always keep an emergency plan. That might mean maintaining a personal account as backup, just in case. Example, Sarah and Jake agree to each contribute $1,000 a month. They use that account for mortgage, utilities, and food. For personal hobbies or gifts, they use their own separate accounts. Number 12. The bottom line. A joint bank account is not good or bad by itself. It is simply a tool. The success of that tool depends on the people using it. For some, it creates harmony and teamwork. For others, it can create conflict and stress. The key is to know yourself, know your partner, and be honest about your habits. Number 13. Joint accounts and credit scores. Here is something many beginners misunderstand. A joint account by itself does not build or hurt your credit score because checking and savings accounts are not reported to credit bureaus. But if that account goes negative and you cannot cover the fees, the bank could send the debt to collections. That collection can show up on both of your credit reports and hurt both of your scores. So even though the account does not directly help your credit, mismanaging it can absolutely damage it. Number 14. Joint accounts for business partners. Sometimes two people starting a small business decide to open a joint account for simplicity. This can be risky. Unlike a business bank account set up under a legal business entity, a joint personal account leaves both people personally liable. If the partnership fails, one person could empty the account and the other has no recourse. Example, two friends, Ben and David, start a landscaping business. They use a joint personal account for client payments. When the business struggles, David takes out the remaining money. Ben has no way to stop it. Number 15. Joint accounts and government benefits. If you receive benefits such as Medicaid or supplemental security income, having your name on a joint account could count toward your resources, even if the money belongs mostly to someone else. This might make you ineligible for certain benefits. Many people overlook this detail and face problems later. It is always wise to check the program rules before adding your name to a joint account. Number 16. Protecting against financial abuse. Joint accounts can sometimes lead to financial abuse in unhealthy relationships. If one person controls the account, they might restrict access or monitor every transaction. This can make the other person feel trapped. Financial abuse is one of the most common forms of control in toxic relationships. If you ever feel like money is being used against you, it is a red flag and a reason to keep accounts separate. Number 17. Tax considerations. Most banks report the interest earned on a joint account under both account holders' Social Security numbers. That means both may need to include the income on their taxes depending on how much they contributed. For example, if you and your spouse earn $20 in interest, you may each report half of it on your tax return. It is not complicated, but it is another detail people sometimes overlook. Number 18. Emergency access. One often overlooked advantage of joint accounts is quick access during emergencies. If one partner is hospitalized or unavailable, the other can still pay bills and manage money without delay. With individual accounts, you might need a power of attorney to get the same access, which can take time. Number 19. Setting up alerts and boundaries. Most banks allow you to set up text or email alerts for spending and deposits. This can help both account holders stay in the loop. For example, you can get a notification anytime more than $100 leaves the account. That way, there are fewer surprises. It is a simple tool that helps prevent misunderstandings and builds trust. Money has the power to bring people closer, but it also has the power to pull people apart. The choice to open a joint bank account should never be made lightly. So here is my question for you. If you had to decide today, would you feel safer with your money combined in a joint account? Or do you feel more comfortable keeping it separate?